Hello from Altered Markets. This is Ahura. Will be with you to have to take a look on the U.S. inflation data and see what was the result, how we were expecting to be, and what's the market reaction to this data. As always, first let's check the data and information that we have, and then we can see the market reaction as well. So as data shows us here, core inflation was steady at 3.2% in annual basis as it was expected. Headline inflation fell from 2.9% to 2.5%, no surprise as it was expected. Headline inflation on the monthly basis increased only 0.2% as it was expected. But there is a expectation. There is something that is more than expectation, and that's the core inflation. Core inflation on the monthly base, which is very important, it shows that how the market reaction, how the market's moving on right now, increased by 0.3%, a little bit more than expectations. Core inflation means that we exclude the price of food and energy, which they are so volatile, and so we check the data without these numbers. Since the oil and generally the energy prices have been falling in the last months, when we see that the core inflation increasing, it means that if any case happen, and for any reason, for geopolitical reason or whatever it happened, if the energy price increase again, then that can affect the market very badly, and inflation can increase much faster than expected, as inflation in other parts is increasing, especially in the service sector, which is about 5.7%. These numbers and this data shows that for now we do still have the risk of higher inflation and increasing the inflation in the market. So that cannot support the higher, bigger rates cuts in the next Federal Reserve meeting. So this data generally shows that there is still the risk of recovering the inflation and increasing the inflation. So let's go and check the markets and see the market, how the market react. Before checking the markets, different markets, this is FedWatch Tools. FedWatch Tools was something like 28% chance. It was showing about 28% chance for 50 basis point rate cut for September meeting. Right after the data, it fell to 13%. I think it's right now a little bit of unchanged, but generally it's about that. I mean, from 28% possibility or chance for rate cut, 50 basis point rate cut from before, which we had before data published, it fell to almost right now to 15%. So something about 13% difference or less chance for 50 basis point rate cut. So which means that higher for longer can continue at least for one more month. So higher rates, because the higher rate right now, the rate is 5.25%. So if you cut it, it still will be the 5%, and it's so high. So the higher rates still can continue for at least one more month, because we will have only 25 basis points. Just to add it, all right, last night we had a debate, the first debate of between the Kamala Harris and former President Mr. Trump as well. With the uncertainty right now that we have in the market, we don't know which one we're going to win. And still, even if we know which one going to win, we cannot expect to see right now with the situation that right now we have in the market. We don't know what market reaction will be to which of them, because Donald Trump is probably working better on the economy, so it can support the economy, so dollar can get a little bit stronger, possibly. But on the other hand, what we have for the Kamala Harris with the plans that they are planning to support the more like small businesses with the giving the tax freeze and stuff like that. Some support to the taxes, so that can also from other side can support the economy. We don't know what exactly market reaction can just like going to be, especially now you're just talking. It's the time of election time, so you're just talking. What's going to happen in reality? It's going to take you time to understand it. So market, it means that we are in uncertainty, and this uncertainty usually it's not in favor of the stock market. Let's check the markets and market reaction after these data. That's the gold price. Let's start first with the US dollar index, and then we can check the markets in the gold. So US dollar, it's normal to see the US dollar a little bit increase after this data because higher for longer can continue. Higher rates can support the US dollar index for now and can hold the dollar rates. So for now, we expect to see the US dollar not to fall at least, but we're increasing a little bit more not so fast increase also. We can see the US dollar index until next meeting of Federal Reserve on September 18, something around this level, 100, 150, and 100, 240, 230, something like this area. This is the area that we're looking to see the US dollar index for the next days. On the other hand, on the stock market, if you look at the S&P 500 as the main stock, just like, but for now, we didn't have any specific reaction, not falling, not increasing. So just like market is not moving right so fast after that because that was expectation. I mean, the market is increasing, just like core inflation increased a little bit more than expected. But still, 25 basis point is something that already pricing in the market. So that cannot change the market, which means the overall or general slightly this downtrend that we have in the market can continue. So we don't have any reason to say that, okay, right now is the time to market increase now. There is a reason to say that, okay, we have a higher for longer, more pressure on the stock market, so slightly downtrend in which we have in the market can still continue after this data. As the gold, if we check the gold here, right after the data, as the US dollar index increased, so we had a pressure on the gold, but that was because of a stronger US dollar. But if we check the market, we see that there is a risk in the market, uncertainty because of the election and other things on one hand. On the other hand, the data that we had which means that the higher for longer can continue. And that means the pressure on the stock market. Generally, all of them, they're put together. If you put them together, you can see that right now we have a more demand for risky markets. We have more demand for less risky markets, and because there is a more risk in the market, so less risky markets such as gold, because there is a risk in the market, but the gold compared to the stock market is a less risky market, so more demand for the gold can hold its bears for now. That's why we can see still the gold in a slight uptrend, and gold can continue its demand as long as there is uncertainty in the market, even thought if the US dollar is getting a little bit stronger. This is some data on the market reaction, but if you had any other question, if you had more question, please don't hesitate to write in the comment section. I'll try to get back to you as soon as possible. Have a good time. Bye.